Welcome back to The Explainer. Today we're going to unpack a massive, multi-billion-dollar shift that is happening in the global EV market right as we speak. For years, we've basically just watched a non-stop, massive boom. But right now, we're looking at a sudden, severe market bust, followed by a completely fascinating high-tech pivot that's honestly going to change the global automotive landscape forever. Let's get right into it.
Okay, so let's just dive right into this. Negative 55.4%. Wow. That absolutely shocking number is the year-over-year net profit drop for BYD in the first quarter of 2026. Keep in mind, this is the world's best-selling EV maker. This is a company that recently overtook Tesla in pure electric sales, and they are suddenly watching their profit margins literally collapse. This single number really sets the stage for the industry-wide crisis we're exploring today.
So here is our roadmap for the explainer. We'll start with the EV profit collapse, then look at the looming 2026 subsidy cliff. After that, we'll see why EVs were actually omitted from China's 5-year plan, explore the global expansion escape, look at their wild pivot to high-tech futures, and finally, wrap up with the new EV reality.
Starting off with Section 1, the EV profit collapse, and how the domestic price war eroded margins.
Just take a look at this contrast. Over in Europe's top 5 markets, battery electric vehicle, or BEV sales, surged by a record-breaking 36% in the first quarter. But then you look at China's domestic market, sales contracted by 20%. The domestic market there has just become hyper-saturated. And you know what happens when demand shrinks? It ignites a completely brutal domestic price war.
And the financial fallout from this price war is pretty staggering. I mean, it's not just BYD taking a massive 55% profit hit. Look at XPeng. Their vehicle deliveries actually surged an incredible 149%, yet their stock crashed 10% after earnings. So what does that tell us? It means record deliveries just do not guarantee profits in China anymore, largely because companies like Geely and Li Auto are voluntarily eating their own profit margins to slash retail prices just to maintain their sales volumes.
Which brings us to Part 2, the 2026 subsidy cliff and the end of the tax exemption era.
Since the very beginning of the EV boom, Chinese consumers have enjoyed this massive safety net, a new energy vehicle tax exemption worth up to 30,000 yuan. But look at the timeline here. In 2024, it was a full exemption, but now in 2026, that exemption gets cut in half to a 15,000 yuan max. And by 2028, it disappears entirely. So consumers are losing their tax breaks, and that forces these automakers who are already bleeding money to cover that tax gap out of their own pockets just to keep cars moving off the lot.
So, what exactly is Beijing's macro strategy in all of this? Let's move to Section 3, omitted from the 5-year plan.
Now, what's really interesting about this slide is that final bullet point. For the first time in over a decade, electric vehicles have been completely dropped from China's 15th 5-year plan as a strategic emerging industry. Gone. Instead, the state is pivoting its massive resources towards stuff like quantum technology, biomanufacturing, hydrogen energy, and nuclear fusion. The era of endless state-sponsored EV expansion, it's officially over.
Instead of subsidizing EV production left and right, the government is shifting to a new doctrine. It's called carbon dual control. Basically, this is a major policy shift. It moves away from simply limiting how much total energy the country uses to strictly limiting total carbon emissions. So the focus now is on peaking coal and oil and integrating climate goals across all financial sectors rather than just flooding the domestic market with subsidized cars.
Which naturally brings up a pretty critical question for us to think about. With domestic profits collapsing, the price war raging, and government subsidies disappearing, where on earth are these massive Chinese automakers turning to survive?
The answer is in Section 4, the global expansion escape, and localizing in Europe.
Exporting to find higher-margin customers sounds great, but it really isn't that simple. Analysts use something called the Burger benchmark to show how statutory charges impact final list prices. But honestly, exporting an EV is a lot more complicated than ordering a burger. If you produce a car in China and sell it in Germany, which is scenario D here, you don't just pay a 19% value-added tax. You also get hit with a 10% import duty, plus additional trade defense duties. That completely changes the economics of exporting.
And, to make matters a bit more complex, those trade defense duties are constantly evolving.
The EU and China recently agreed on a framework that establishes minimum import prices for Chinese EVs. The whole idea is to level the playing field and prevent subsidized imports from undercutting European automakers. But, importantly, the EU has made it clear that they remain open to direct Chinese investment under certain defined conditions.
So how exactly do Chinese automakers respond to minimum import prices and heavy tariffs? Simple. They localize. BYD is actively transforming from a Chinese importer into a European manufacturer to bypass those very tariffs. They've already got trial production starting in Szeged, Hungary in Q2 of 2026. A second plant is scheduled for Manisa, Turkey. And they're already reviewing a third site in either Spain or Portugal.
But geography isn't their only escape route. Section 5, pivoting to high-tech futures, beyond standard EVs. To really capture that new, high-end, value-driven consumer, Chinese automakers realize they can't just compete on low prices and incremental updates anymore. They are rushing to commercialize solid-state batteries. This is a huge deal. By using a solid electrolyte instead of a flammable liquid one, they practically eliminate fire risks and can boost energy density by a massive 30 to 80%. We're talking way longer ranges and much lighter cars. The race is totally on to get these into consumer driveways right now, in 2026.
But wait, look at this pivot. It is wild. XPeng is literally planning to mass-produce humanoid robots by late 2026. Li Auto has confirmed a 100% probability of entering the robotics space. Meanwhile, battery giant CAT TL is heavily expanding into massive, grid-scale energy storage systems. Plus, we're seeing a mass rollout of 100,000 high-speed EV chargers by 2027. When car companies start betting their entire futures on walking humanoid robots and national power grids, you know for sure the era of easy, straightforward EV growth is dead.
All of this leads us to our final chapter, Section 6, the new EV reality, survival of the fittest. 15. I really want you to remember this stark prediction. Out of the 129 electric vehicle brands currently operating in China right now, industry analysts project that only about 15 will actually survive to the year 2030. 15 out of 129. We are entering an era of absolutely extreme consolidation.
As fund manager Bing Yan notes, quote, "We expect the demand environment in 1Q 2026 to be challenging. Competition may intensify, hurting margins into next year." End quote. The pain in this market is not just a temporary blip. It is a prolonged, structural reality that is going to weed out the weak and really elevate those tech-obsessed survivors.
Which leaves us with one final provocative thought to take away from this explainer today. As China's surviving EV giants shed their reliance on domestic subsidies and aggressively pivot toward things like solid-state batteries, localized European factories, and even humanoid robots, is the rest of the world truly prepared to compete in this leaner, hyper-advanced era? Thank you so much for joining me to explore this. Keep that question in mind as we watch this incredible market evolve.